In this video, we're going to be looking at fundamental analysis, and to help ourselves understand this a little bit more, we will be defining it through a generic definition. Then we will move on to look at quantitative and qualitative factors. We'll deconstruct the stages of fundamental analysis with a popular top-down approach, which we'll explain a little bit later. And we'll ask ourselves why fundamental analysis works, giving examples of its importance and an explanation in detail. So, what is fundamental analysis? Well, we'll pop a quick definition up on the screen. This will help us understand what we'll explain in a couple of moments or a couple of slides down the line. Well, fundamental analysis accounts for the set of research processes used to analyze the intrinsic value of a security. And you're probably wondering, what is a security right now? Well, a security is simply a tradable financial asset. So an example of an equity security can be found through common stocks, and an example of a debt security would include things like bonds, which you may have heard of already. And there are 4 points in which we conduct fundamental analysis: through studying the economy, sectors, the companies within, and thus the valuations of those companies through traditional valuation metrics. And you can combine both quantitative and qualitative elements to make better investment decisions. If you're wondering what quantitative factors are, well, they are numerical. So an example of this in practice would be relative profitability. Say two businesses in the same sector you would have in a situation, and then you have one that is much more profitable than the other, one that is obviously not so profitable, and then you're able to make a decision from there whether you want to invest. You'd obviously go for the better one. That is a quantitative factor in that circumstance. And a qualitative factor relates to qualities and characteristics. So an example of this would include the motives and intentions of management. Say if you have those same two businesses, one set of management or a team of board of directors are profit focused, which is healthy, profit focused for the business. And then you have other directors that are incentive focused, the ones that want to create bonuses, get higher salaries each year, regardless of performance. It might be a good idea, for example, as a business, to include options. If a business can improve their margins beyond a certain rate for, say, 3 years back to back on an average, then you would give them a little bonus. That is a fair bonus. But if a manager gets a bonus on the back of higher share prices, what if the share prices crash after they exchange these options and sell those shares? They get the free shares and they leave. That would be really horrible. So we just got to think a little bit deeper when it comes to these elements. But hey, let's look at the 4 stages of fundamental analysis. You've got the economy first, you've got the sector, you look at the economy, you look at the sector, you look at the company, then you look at, say, the deeper things within the company, the balance sheet, all that stuff. You use valuation metrics, all sorts of stuff. But whilst it isn't necessary to research in this order, the 4 areas that we've just shown in this diagram detail what is involved in fundamental analysis. This particular order, however, is referred to what we mentioned a little bit earlier, a top-down approach. So you'd begin by looking at the economy-wide data, identifying trends of things like shifting consumer spending patterns, changes in regulation, unemployment data, CPI data, and all sorts of useful indicators you could imagine that will help you in your due diligence process. And after getting your wider look, you would then move from the economy to the sector. Say if you're looking to go long into an investment, you'd look to identify sectors with potential to grow at a rate faster than most of the other sectors out there. And if you're looking to go short on an investment, you'd do the opposite, where you'd look for sectors with not so positive near-term outlooks. So an example on the long side, if you're looking to make money from things going up, could be seen through oil and gas exploration and production stocks from the beginning of half 2 2017 to the end of half 1 2018. This same sector was in chaos from early 2014 to early 2016. If you want to have a look at that, feel free to do that in your own time, because in that situation we talked about when the oil and gas exploration and production sector was in chaos from early 2014 to 2016. That was as a direct result of oil prices crashing from over $100 a barrel to about the 30s at a point, $30 odd a barrel. And evidently, oil stocks suffered during this period. And this brings us on to the individual companies. It is best to have a look at a basket of companies per sector in order to determine relative valuations. And by this, I mean notifying the differences in, say, PE ratios, price to earnings ratios, and such other metrics between companies in the same sector. Not only do you look at financial performance for a company, but you must also remember the importance of good management, of whom materialize the future growth prospects of a firm. And after comparing the equities in your basket of stocks, you can then dive deeper into the financials of each company that meets your own personal investment criterion. And all the variables regarding the economy are useful in predicting future levels of economic performance. Stable inflation, as we've got here on the screen, low rates of unemployment, consistent GDP growth, and suitable interest rates are all variables, or situations rather, that allow businesses and ordinary people to borrow and invest in the domestic economy. These are all ideal conditions for long-term investors, of whom it is in their interest to see higher rates of return on their respective market indexes. We should also look through sector-related data and variables. Well, let's just say the oil and gas sector. When you have higher oil prices, the sector is generally correlated with higher returns. But we have seen situations where commodity prices have been much higher, but the sector as a whole, in terms of equity pricing, say an ETF that represents oil stocks in general, had been suffering. The indexes around had been suffering. So there's not always a clear correlation, but it's important to know that if commodity prices are suddenly soaring, maybe a sector that was not loved before may shine in the spotlight. Who knows? And when you're screening those industries, it might be important to maybe look at, say, a sector that for 10 years has had negative returns and all of a sudden had 1 year, and that was a recent year, where there were positive returns. You can maybe screen on that criterion, maybe code something for that, or just use a manual screening tool, and you'd be able to identify some one-off changes and then look a little bit deeper. Rotation's a good example as well. So some sectors have good years, some sectors have bad years, and normally there are rotations that occur within. So we had oil and gas, as we just mentioned. Oil and gas had a really bad set of years from 2014 to 2016, but after the lows were in, there were some monstrous recoveries in the sector, and it's important to follow rotation. A couple of years ago, construction was struggling, and then you had some of the biggest competitors, including Carillion in the UK, forced out, and places like Balfour Beatty remained with the opportunity to take up a lot more market share, operate at better margins because there were no other competitors in, say, particular projects. There are a lot of competitors, but the margins are super low, which is important to consider. Margins are super low at a time where a business is operating, then things are hard. But what if margins can start improving because of less competitors? More competition means normally lower prices. You won't make that much money selling things. But if the bad companies are forced out, the ones losing money are forced out, the ones that remain can stand to make a lot, and that sector could be in rotation. Who knows? You'd have to look a little bit deeper on a quantitative perspective. And SWOT analysis, which many people are probably familiar with, this looks at strengths, weaknesses, opportunities, and threats in general of the sector. So we'd ask ourselves, what is the future of this sector? What is an opportunity within? What is a threat? For example, with oil and gas companies or the sector as a whole, impairments are a huge problem. They can have huge write-downs on their assets, especially correlated with changes in commodity prices, oil prices in this case. And it would be important to know that you could wake up one morning and see a company have a huge impairment and their shares could be down 40-50%, which actually happened quite a lot in 2016. And we've got a couple other data/variables that we can look at here for the other two sections that remain. We've got companies, relative valuations. So one company could be valued at a price to earnings ratio of 5 in the same sector as another one that is valued at a price to earnings ratio of 8. you would look at the average for the sector, then you would compare the price earnings ratios of different stocks within the sector, and you would try and see what's an anomaly. Why does it differ? Why is one fairly priced or cheaply priced with a lower PE? Why is one expensively priced or overpriced, who knows, with a higher price earnings ratio? That is the important thing that we would then be able to dive deeper and understand from those figures. And also a business model. We have a separate video in the series where we look at business models, the shift from retail to online, traditional retail where you had people on the high street selling stuff, to online businesses paying very little in terms of costs for the properties, of which commercial rents could be super high, but online businesses don't have to pay that. They don't have to employ many people. That whole model is much more profitable than the traditional retail model, and so it thrived. And there are many other business models that have different variations. It's not just online versus retail. There are so many different things. For example, with cars, electrical, or rather non-electrical versus electrical, because electrical is the new hype in that area. And we can also look at correlations. So for example, things like beta multiples, one stock moving relative to an index that it's in. If the index is down, how much is that down? And then compare, say, a year's worth of beta, 90 days worth of beta, all sorts of things. And you can spreadsheet these things with ease. And also the management of the business. We have a separate video in the Essential series also for the area of management, because it's important to know who is in control of the business of which your cold hard cash is in. And also, if you're shorting a business, you'll be able to identify poor management and thus be likely to make more money on the back of those mistakes. So there are two ways to make money in that case. And on the valuation side, we have separate videos in our FA series as well on income statements, balance sheets, and cash flow statements, and also models, valuation models, discounted cash flow, etc. Those kind of things are what we will also look at in separate videos. But I've just put some brief things here because when you look at an individual company, you normally look at such things here to compare to your own perception of a business. So, why does fundamental analysis work? Well, whilst the exact definition of arbitrage refers to taking advantage of price differences in different markets to make a profit off that imbalance, I think strong fundamental analysis in essence allows you to determine higher or lower intrinsic values to compare against what the market deems to be fair value for a stock through its market cap. And if your analysis points to, say, an underrated statistic, for example, rapidly increasing profitability on the back of higher commodity prices, like we mentioned earlier, then you're able to buy into that company's shares. And if your analysis is accurate, say if the price approaches your interpretation of fair value, then you're able to sell your shares at a profit, capitalizing from the arbitrage of information. And if a stock's outlook via technical analysis indicates that it has been in a consistent downtrend for a long period of time, yet the outlook via fundamental analysis points to a transformational change in the company's valuation, for example, in the near term. An investor with high conviction could buy shares, and assuming this technical downtrend reverses eventually to an uptrend, the investor's fundamental analysis would have positioned them to reap significant rewards. So essentially, by catching the reversal of the trend before it happens, you'd be winning. And fundamental analysis allows you to see the change before it really comes into action. It depends what your perception of the market is, but a lot of the times, I've seen myself, you see the fundamental change occur, a formation kind of situation, and then when the company continues to perform, the shares completely break out and you just see huge upwards movement, and you can get a fair bit of returns as a long-term investor in turnaround stocks. There were many stocks in 2016, oil stocks, that were on the brink of going bust, priced for bankruptcy, but were able to survive. And those ones had many multiples in terms of their performance over the next, I believe, 2 years after that, which was pretty cool and would be a great feeling if you were an investor in that, certainly as I'd felt. But The third bit we'll look at as to why fundamental analysis works is by identifying things like high quality management, for example. You'll be able to reduce the risk of occurrence of companies experiencing periods of extreme share price volatility. And you can get peace of mind by analyzing deeper. You would get the peace of mind by, say, trusting management. The presence of trustworthy management could prevent accounting scandals, embezzlement, and all sorts of nasty scenarios. And by using fundamental analysis in this case, it would be placing an investor at ease. If you're the investor, that places you at ease. Ultimately, though, we must be asking ourselves the question of why we actually use fundamental analysis. Well, it helps with making an informed decision, and that is using empirical data, real data, reliable data. A lot of people have opinions. For example, one would say short Royal Mail because the business model is suffering versus Amazon. Fine, but where is the empirical data? That is totally a true assumption if someone were to ask me, but then you ask yourself, what about the exact price at the time? Aren't shares down above 50% in the past year alone? Why would you short now and not short before? Wouldn't you be closing your short now or considering at the current moment? Do you see what I mean? That is the situation we have to consider before just putting an opinion out there. It's fine to put out opinions, but you should put those opinions out as hypotheses and dive deeper. And there's an interesting part of fundamental analysis that we haven't really dived deep into today, but there will be separate videos available on our site in the near future, if not already now by the time this video goes up. And we would look into models, because by using fundamental analysis, you're able to determine future rates of growth for different securities. So say if you're looking at a sector that's expected to grow by X amount of percentage points a year, then you can use that empirical data, back it up, assume if it's a true assumption or not. If you disagree, come up with your own percentage expectation and then dive deeper and then see what that impact is on stocks. So for example, in 2016, oil and gas wasn't the only thing that had a recovery post that period. You had iron ore companies in the UK like Evraz and Ferrexpo took symbols EVR on the LSE and FXPO on the LSE, I believe, off memory. Those companies had recovered on the back of iron ore pellet prices, 65% Fe, I believe. Prices were just recovering, and you could see the indexes, well, the stocks rather, in the different indexes that had relation to that commodity had recovered accordingly. And it's interesting that the future rates of growth for prices of, say, different securities had some form of connection to that, which is quite important. And we'll dive deeper to that on a separate occasion. But ultimately, by using fundamental analysis, you can keep up to date with the dynamic world. A lot of people say, I don't use fundamental analysis. A lot of people say, I don't use technical analysis. Well, what if we look at all factors and see what is valuable to our process and improve our understanding of this world and the investment world rather, much greater? And by doing so, we'll be able to earn a detailed understanding of businesses and sectors just from the FA side. The more businesses, structures, and industries that you research into, the more knowledge you will gain, and thus you will be able to apply this knowledge to your investment decisions in the future.